Every day, millions of investors stare at charts, convinced they can predict the future. They believe they'll buy at the bottom and sell at the top. This is called timing the market, and it almost never works. Between 1998 and 2017, the stock market returned roughly 7% annually. But if you missed just the 10 best days in that 20-year period, your returns would drop to barely 3%. Half your gains, gone. And if you missed the 20 best days, you'd earn less than 1%. Here's the brutal truth. 6 of the 10 best days occurred within 2 weeks of the worst days. When you flee the market in panic, you almost certainly miss the rebound. The data is overwhelming. Time in the market beats timing the market. So what's the alternative? A strategy called dollar cost averaging. It's beautifully simple. You invest a fixed amount at regular intervals, regardless of price. When prices are high, your fixed amount buys fewer shares. When prices drop, that same amount buys more shares. Over time, this naturally lowers your average cost per share. You don't need to predict anything. The math does the work for you. Let's see this in action with a real example over 6 months. Imagine a stock that starts at $50, drops to $25, then recovers to $50. A market timer who bought at $50 and sold at $25 lost half their money. Panic selling locked in their losses permanently. But the dollar cost averager invested $100 each month for 3 months. At $50, they bought 2 shares. At $25, they bought 4 shares. At the recovery price of $50, they bought 2 more shares, 8 shares total. Their average cost? Just $37.50 per share. When the stock returned to $50, they had made a 33% profit. The market timer lost money. The steady investor profited. Same stock, same time frame. This isn't a trick. It's the mathematical advantage of consistency over prediction. Vanguard studied this across multiple decades and international markets. Their findings were definitive. Lump sum investing beat dollar cost averaging about 2/3 of the time. But here's what the statistics don't capture. Human psychology. Most people cannot invest a lump sum and watch it immediately drop 20%. They panic. They sell. They lock in losses and abandon the strategy. Dollar cost averaging succeeds because people actually stick with it. The average equity fund investor holds for just 3 years before abandoning their strategy to chase recent performance. Researchers call this the behavior gap, the difference between investment returns and investor returns. Over 20 years, the average equity fund returned 9% annually. But the average investor in those same funds earned just 3.6%. 5.4% of potential gains destroyed by poor timing decisions. Think about that. Almost $200,000 lost on a $100,000 investment over 30 years. The damage came from buying high during excitement and selling low during fear. Our brains are wired exactly backwards for investing success. Evolution made us excellent at running from tigers, not holding through market corrections. When your portfolio drops, your amygdala screams danger the same way it would for a physical threat. This is why automated investing is so powerful. It removes emotion from the equation. You set your schedule. Weekly, bi-weekly, monthly. The exact timing matters less than consistency. Warren Buffett, perhaps the greatest investor alive, advocates exactly this approach for most people. He recommends low-cost index funds with regular contributions over decades. Not because it's exciting. Because it works. Let's address the obvious question. What about the incredible success stories? What about those who bought Bitcoin at $1 or Amazon at its IPO? Survivorship bias distorts our perception. We only hear about the winners. For every Amazon, thousands of early internet companies went to zero. Nobody writes articles about the person who timed Pets.com perfectly. The few who successfully time the market consistently are statistical anomalies, not reproducible models. Studies of professional fund managers prove this conclusively. Over 15-year periods, more than 90% of actively managed funds underperform simple index funds. These are professionals with armies of analysts, algorithms, and inside information. If they can't beat the market consistently, what chance does an individual investor have? The answer isn't better predictions. It's abandoning the prediction game entirely. Dollar cost averaging isn't just an investing strategy. It's a philosophy. It acknowledges that we cannot see the future, and builds that uncertainty into the plan. Some months you'll feel like a genius, buying at a temporary low. Other months you'll wince as you invest right before a drop. Neither matters. The individual transactions are irrelevant. Only the long-term average counts. Think of it like buying groceries. You don't time your milk purchases based on market conditions. You buy when you need to buy. Investing should be equally mundane. The real magic happens over decades, not days. Compound growth transforms modest monthly contributions into significant wealth. Consider this: investing just $300 monthly at 8% returns for 40 years. Your total contributions would be $144,000. But thanks to compound growth, your portfolio would exceed $1 million. That's not a prediction. That's mathematics applied with patience. Now let's be honest about limitations. Dollar cost averaging isn't perfect. In strongly rising markets, investing everything immediately technically produces better returns. But markets don't rise steadily. They surge, crash, recover, and crash again. The psychological armor dollar cost averaging provides is worth the mathematical trade-off. Implementation matters. Start with your employer's retirement account, especially if they match contributions. That match is free money. Never leave it on the table. Automate everything you can. The less you think about it, the better you'll do. Check your portfolio as rarely as possible. Quarterly is plenty. Monthly if you must. Never check daily. That way lies madness and terrible decisions. The ancient Stoic philosophers understood something modern investors struggle with. Focus on what you control. Your actions, not outcomes. You control whether you invest regularly. You cannot control what the market does tomorrow. Accepting this distinction is the foundation of successful long-term investing. The market will crash again. That's not a warning, it's a certainty. When it does, the market timers will panic. The dollar cost averagers will continue. While others flee, you'll be buying shares at a discount. Not because you're brave, because you have a system that doesn't require bravery. Consistency isn't glamorous. It won't make you a viral investing story. But 30 years from now, you'll be glad you chose the boring path. Time in the market, consistent contributions, patience. That's the formula. Not because it's exciting, but because decades of evidence prove it works. Stop trying to predict the unpredictable. Start investing consistently today. Your future self will thank you for choosing simplicity over sophistication.